Welcome to This Explainer. Look, if you've been up late scrolling through financial advice, trying to figure out how to multiply your money without losing your shirt, you are in exactly the right place. Today, we're diving straight into the data to solve the dilemma of what to actually do with your hard-earned savings.
25 grand. You didn't just stumble into this money. You saved it through sheer sacrifice. Maybe you skipped vacations, said no to going out, or drove that same car for way too long. And now, ironically, it's probably just sitting in your bank account while you're completely paralyzed by the fear of making the wrong move.
So, what is the single most expensive mistake you can make right now? Well, doing absolutely nothing is a terrible choice. But trying to actively outsmart the market, that is a shockingly close second. The data reveals a completely counterintuitive truth. It's actually the lazy investors who win.
All right, here is our roadmap for today's explainer. 1. The lie of active investing. 2. The invisible wealth killer. 3. The three-bucket strategy. 4. Rich Richard versus Poor Peter. 5. The math of lazy wealth. And finally, how to start today. Let's get right into it.
Section 1. The lie of active investing.
In almost every other area of life, grinding harder pays off. But investing, it is the rare exception. In 2024, the average person actively trading stock funds earned around 16.5%. Sounds pretty decent, right? Well, not when you realize the S&P 500 index returned a massive 25% that very same year. That huge gap would have cost a $25,000 portfolio over $2,000 in a single year, simply because the investor tried to be clever instead of just participating in the market. Honestly, you are literally better off flipping a coin than trying to time the market. Average investors guess the market direction correctly only 25% of the time. That's led to 15 straight years of underperforming the market index. And the damage from this behavior? It compounds drastically. $100,000 left completely alone for 20 years grew to over $700,000. But if you constantly fiddle with the controls, buying late, panic selling, that same $100,000 only grows to about $345,000. Touching the controls literally destroys your wealth. Section 2. The invisible wealth killer. Now, I know some of you are thinking, okay, I'll just leave it completely safe in the bank. Let me go ahead and burst that bubble for you. Doing nothing with your money exposes you to a slow, invisible bleed, where inflation silently eats your purchasing power. Right now, the national average savings account pays a microscopic 0.38% interest. Meanwhile, inflation is hovering around 3.3%. So every single year, your money's real value is shrinking by nearly 3%. To put that into perspective, let's look at a 10-year timeline. While your nominal bank balance might creep up to around $25,900, adjusting for inflation reveals a terrifying reality. The actual buying power drops to roughly $18,700. You effectively lose over $6,000 without spending a single cent. Nobody sends you a receipt for this loss, but keeping all your cash in standard savings is incredibly dangerous to your future.
Section 3. The three-bucket strategy.
So, how do we find the sweet spot between the invisible bleed of the bank and the active destruction of day trading? The trick is dividing your $25,000 into 3 exact proportions to automate your growth and protect you from your own emotions. We call them the Sleep Well Fund, the Wealth Engine, and the Opportunity Reserve.
Here's exactly how these buckets operate. First up, your Sleep Well Fund takes 20%. That's $5,000. You pop this into a high-yield savings account earning around 4%. This is strictly for emergencies, so a random medical bill never forces you to sell your investments at a loss. Next is your Wealth Engine. This holds 70%, or $17,500, in a broadly diversified total stock market index fund. Think VTI or VT. You're aiming for that historical 10% average annual return. No stock picking, just owning the whole market. Finally, the Opportunity Reserve takes the last 10%, $2,500, placed in short-term treasuries. This system ensures you never have to panic sell, your main wealth quietly grows in the background, and you still have dry powder to buy when the broad market inevitably drops by 15% or more.
Section 4. Rich Richard versus Poor Peter. To see this theory in reality, let's take two 32-year-olds who each start with $25,000 and contribute $400 a month. Poor Peter treats investing like a full-time job. He buys individual stocks, checks his portfolio daily, and panics during dips. His behavioral tax drags his return down to 5%.
Rich Richard, on the other hand, spends 20 minutes setting up his automated total market index fund, deletes the app, and just goes back to living his life. Richard's laziness secures him a 10% return, netting him a massive $487,000 over 20 years. The completely lazy guy beats the exhausted hustler by nearly 280 grand. Laziness literally wins.
Section 5. The Math of Lazy Wealth.
Let's dig into the actual timeline required to hit our $250,000 target, because that initial lump sum is really only half the battle. If you rely entirely on that initial 25K, it'll take about 24 years to hit 250 grand. That's a long time. But look at how funneling extra income, like raises or bonuses, into your automated monthly contributions dramatically speeds things up. Just adding $300 a month shaves almost a decade off your timeline. Bump that up to $400, it drops to 14 years. And if you can push it to $500 a month, you cut the total time nearly in half to an incredibly fast 12 and a half years. Your ability to grow your income is the ultimate fuel for this automated machine. And here is the true, absolute magic of this system. Once you hit this inflection point, the compounding accelerates so rapidly that your money generates more wealth for you than you could ever save manually. Think about it. Your first year of investing, that 25 grand, earned you about $2,500. But once your portfolio hits $250,000, that same 10% return is generating $25,000 in a single year. Your money is now producing the exact same amount it took you years of skipping vacations to save in the first place. You just have to be consistently lazy long enough to reach this tipping point.
Section 6. How to start today. Knowing all this math doesn't help if you don't take action. So here is your immediate execution plan. Step 1. Spend 15 minutes opening a commission-free brokerage account. Step 2. Divide your 25K into the 3 specific buckets we just discussed. Step 3, and this is critical, set up automatic monthly transfers from your checking account for the day after your paycheck hits. Finally, Step 4, set a calendar reminder to spend maybe 20 minutes, twice a year, rebalancing your portfolio. You're entirely removing your own willpower from the equation. The system just works in the background while you focus on your actual life.
But to make sure this flawless system actually works, you have to protect it from its biggest threat, you. Seriously, tape a physical sticky note somewhere you'll see it that says, "Do not touch this." Surviving market crashes without panic selling is your only real job. When the market crashed 30% in a matter of weeks early in the 2020 pandemic, the active investors locked in permanent losses by panicking. But the strategically lazy investors who followed this golden rule, they completely recovered within months.
Your $25,000 is a seed. Right now, it's just sitting on a shelf in a standard bank account, collecting dust and silently losing its value to inflation. The data we've explored today proves that laziness in investing isn't a flaw. It's a strategic superpower. You don't need perfect timing, and you definitely don't need a hustle. You just need to build the system and get out of its way. So what are you going to decide to do with your $25,000 today?